David Arbit. He is Minneapolis Area Realtors Director of Research and Economics. This is a monthly webinar that he hosts for the monthly housing market updates, both short-term, long-term, and some interesting market segmentation that he's found since the beginning of the year. And this should be a great one since it's the first one of 2022. And with that in mind, take it away, David.
Awesome. Thanks, Jackson. Jackson has just been a tremendous resource and asset to our team. So we're really grateful to have him here. And I'm really grateful to have him introduce me. So thank you. Thank you. Let's get my share going. I am excited to be here with you guys today. Let's see here. Let's get my share going. So we're going to talk about, we're going to talk about a lot of things. I think the most exciting part of today is going to be looking at some annual numbers. Some of these are going to be preliminary because we don't officially release numbers until Monday. That's when we officially do our sort of year-end numbers. But just know these figures are pretty set in stone, right? Because there's just not that many status changes that come in, although some do. There always are a few. So with that in mind, let us proceed. I always like to start with sort of a surprising fact because it kind of gets people thinking about numbers. 1978 is just as far away from the year 2000 as the year 2022 is far away from 2000, right? So 1978 is the same distance from the year 2000 as 2022 is. Doesn't that seem kind of strange? Crazy. Mind blown. All right, let's talk about the market. So you guys, I want to do something a little bit different today. And what I want to do is I want to kind of hop into InfoSparks with you guys. And I want to also walk through some of our tools, our resources on our website to make sure everybody kind of knows about them and especially knows where they are and the fact that they're there. So let me do this. Right at mplsrealtor.com, I want to show you guys how to get to our stats deck. So this was just published the other day. It's usually Monday, or if Monday's a holiday, it's Tuesday. And so I'm just going to give this a click. It's right in news. Sometimes you might need to view all news on our homepage, but I just want to make sure everybody's aware. I click on the stats deck and got some lovely text and some links here and a little bit of insight, but the magic really is in the latest numbers and indicators. So once I open that, I'll set that later. Now I see our sort of regular and familiar showings charts. So we can kind of see activity by price point. That's always been, I think, and you guys confirm, one of the most valuable aspects to just kind of see activity by price point. Not all price points behave the same. And I really like to look at share. Sometimes the numbers can be a little funky. So I really like to look at share. And the message, the takeaway here is pretty clear. We see a decline in showings on the most affordable product, right? Here, here, and here. So everything under 300K experienced a decline in showings, right, from the year ago period. So from the same week last year. Where do we see gains? I see gains on the luxury side of the market, right? I see gains, well, maybe this is mid-market, right? 3 to 5, maybe that's a move up tier. But as you get into the 6s and 8s and surely $1 million plus, you start to get into the premium luxury brackets. Someone not muted, maybe?
Oh, sorry, that's me. I didn't know I was unmuted.
Jackson. No problem. All right. So share of overall showing activity. This is a useful one. Hey, interesting little stat here, 500 to 600, little bit of a decline, but then 6 to 8 and 4 to 5 are still up. So if you have listings in some of these price points, know that Eden Prairie is different than Wayzata, is different than Richfield, is different than Roseville. So just know it may be useful to use some of the stuff with your sellers, but just know that your mileage may vary. Your experience may vary, of course. Change in showings, again, by price point, just kind of shows where things were up and down. Things are down in the most affordable segments. New listing. So this is kind of an interesting one. And you know what, for this, I actually will pivot back to my sheet here, my slides, excuse me. And so take a look at this. You know, I haven't finalized the colors on this. I want to make it a little bit more clear, kind of what's happening, but they just go in strengthening colors, right? So 2018, kind of the lightest blue, way, you know, in here, kind of hard to see. And then 19, yeah, so 18, and then 19, and then 20, and 21, and then here we are in 22. So I love how clear you can see 2020 really shifted to the back half of the year, right, in terms of seller activity and buyer activity, as we'll see. So first half of the year, you know, COVID hit, people were a little reluctant to have folks in their homes. And so 2020, we really saw this flattening of the curve in a COVID sense, in a pandemic sense, and in a new listing sense. We really saw that curve flatten out. Normally, we have this normal seasonal distribution, right? But 2020 was skewed. Spring and summer market was pushed into fall. We can really see that in the data. 2021, excuse me. Yeah, 2021, little bit more normal. Yeah, a little bit more normal, especially in the back half of the year, that where things really kind of started to feel a little bit more normal. And beginning this year, little bit more normal. Oops, and pending. So this is really where we can see the skew. So look at 2020, flattening out, right? Flattening out in March, really not hitting its peak until September, right? Most of the time, looks like listings hit their peak in May or June, right? Not a surprise, kind of spring, summer market there. But yeah, look at 2020 just bending and leaning toward the back half of the year just because of what happened in the front half. 2021, interesting, right? Sales activity above 2018 and 19, no surprise. That's right? That's a known thing. But look at just how much there's sort of a bulge, right? It's bulging here. It's a little pregnant over here. So we saw 2021 activity kind of shifted into the front half. So 2020 was kind of pushed to the back half. 21 brought a little bit into the front half, but look, sales activity was really strong last year throughout the rest of the year. What's so funky, what's so wonky about that is, look, when we're comparing 21 to 20, first half of the year, wow, 2021 is up, way up. And then in the back half of the year, look, 2021 is down, way down. It's not that 2021 is down, it's above the previous 2 years, right? It's not that 21 is down, it's that 20 was up. And so it makes it look like there's losses here, even though there were gains here. So I just want you guys to understand that can be a little funky. All right, looks like we've got a thought here. Can't quite tell, but are we staring at the lowest number in the past 5 years? This is just pending sales, and it's a kind of a rolling average from January through December of when we see kind of sales activity, you know, peak versus hit its valley. So it's really slow in the winter and then hits its peak, you know, in spring, summer, or in the case of 2020, fall market kind of has a peak. Oh, for new listings, sorry. So the question was, can't quite tell, are we starting at the lowest number in the past 5 years? So we just start from Jan 1. So whatever the new listing figure was, I think I'm understanding you, whatever that new listing figure was, we use that rolling weekly average to plot that on the chart. And we can see, you know, again, just how much new listings sort of skewed toward the back half of 2020. So I hope I answered that. If not, let's talk offline. Okay, let's talk about some longer term trends. Well, now's a decent time to shift back. Let's see. You know, when I was making this chart, I did a little bit of a forecast and I said, you know, interest rates, let's say they're at 3.4, 3.5%. I kind of thought that was a little bit further off than it is. You guys can see the 30 years over 3.5, we're at 3.56. And I actually thought I saw at Mortgage News Daily, I thought I saw 3.7. 3.69 on the 30 years, so just about 3.7. And you can see the trend, right? Beginning of last year, kind of end of 2020, look, we hit 2.65. Unbelievable, unheard of, right? You don't believe me? You should. I'm the guy with the data. Look at this, going all the way back to 1970, right? So that's half a century of data, and never has it been that low. And although this doesn't show data, some do have numbers going back further, and it's even further than that, significantly. I know some of you recall fondly, you reflect fondly on the days of 16, 17, and 18% interest rates. Now, we hear millennials complain about 3.5%. How am I going to eat? How am I going to pay my CenterPoint and Xcel Energy bills, right? So you guys can see there has been upward movement. There has been a march higher. So end of last year, about a month ago, right? About a month ago, we were 3 flat, and now we're 3.5. So that's a difference, right? That's a difference. That's going to make payments a little bit more, I don't think out of reach for most, but maybe an extra 20, 30, 40, 50 bucks a month with that change. So just be aware of that. Okay, let's go back to the fun. So I was saying, right, the reason I said that is because this forecast seemed a little bit of a ways out, right? Let's say we're at 340 and 3.5%. Well, here we are at 3.5%. And I think last year we'll end at 339.9. So we're just about 340. So this is about where we are. And that would bring us to a affordability index number of 128. Guys, don't overthink this. This is a little wonky. Just know higher numbers correlate to better affordability. No surprise, right? Home prices went on sale between 2009 and 2012. And look, affordability soared, right? Soared higher. Peak of the bubble, when rates were high, incomes weren't as high, prices weren't quite as high, but they were relative to that time. We did hit about 110, 111. Assuming we hit 360 and 4%, maybe we'll see that this year. I don't think we'll see 4% this year. I really don't. I could be wrong. But say we're at 360 and 4%, that would bring affordability to 117, which is pretty close to these numbers, right? Which is pretty close to sort of peak of the bubble, lack of affordability. So we're not there yet, but we're starting to flirt with these levels. All right, housing market activity. So simply put, right, it's useful to look at the ratio of supply to demand, or demand to supply. And one of the best ways to look at that, of course, intuitively, is the ratio of closings to new listings. This data goes all the way back to 1967, believe it or not. I had to mine through some of the 3-ring binders. Do you remember those binders back when we used to have paper and things? So there's really a couple notes here. First, I can see cycles, right? A cycle kind of heating up and then cooling down, right? And that correlated to really high interest rates and a recession in 81 to 83, right? So into strength, into weakness. And then we strengthened into 99, 2000, right? Then we had the dot-com bubble burst. And then we kind of saw what happened from there, right? Kind of hitting our bottom at the peak of the next recession, right? The 07, 09 or 08, 09, before we've stomped ever higher. So the ratio of closings to new listings, the way to read this is there were about 88 closings for every 100 new listings, right? 88 closings for every 100 new listings versus 81, 63, but also 41 and 30 and 40, right? So this is as high, this is as tight as supply and demand has been since 1967. That's only as far back as I could find data. I am certain it goes back further than that. I just can't tell you how far back that goes, but I know it's further back than that. So really an absurdly strong showing here, turnout here on this figure. Okay, let's just look at December really quickly, guys, and then we'll pivot into some year-to-date stats, I promise. Oh, okay, let me look here. So I think they're asking if 2022 starting inventory is the lowest it's been in 5 years. Yes, absolutely. That answer is yes. Back then, though, we were looking at new listings, not just active listings, right? So you can have an active listing today in January that was actually listed in October or November. I think that's fairly unlikely given the pace and days on market in our current landscape. But new listings in January must be listed in January. Active listings in January could be listed months ago. So just a little point of clarification there. December new listings, you guys, look at that. We saw a nice run up in in 2020. Some people thought, oh my goodness, is the supply crisis behind us? We're just going to start gaining inventory, right? Wrong. No, you'd be wrong, right? So we had to come back down 25.48. I suppose I'm slightly encouraged by the fact that we were up from 2019, right? Not by much, by what, 23? Not a ton, but at least we didn't fall below. But you guys can see, right? We're at pretty low levels, minus this sort of, sticking out like a sore thumb, this sort of pie in the sky here. We are looking for an uptrend here, and we're not, well, maybe we're kind of starting to see one, right? Kind of ignoring this anomaly or outlier. But we just have so much work to do to get back to levels that we need to fuel the current demand in the marketplace. Pendings, December, signed contracts, right? Up 17% in 2020, had to come down 12% last month. But here again, right, 3,200 versus 3,284. It's nice to see we're still on a little bit of an upswing compared to 2 years ago, because 2020 was just a wonky year, right? 04. Nice sales activity there. There were some months where we did break, where we did hit all-time highs. It just wasn't for December. So closings, similar story. Closings lag, you guys. Pendings lead the market, right? Closings happen after the contract's written. But of course, we don't see the price until the deal is kind of closed. So closings aren't down as much as pendings, because pendings we see sooner. It's the thing before the thing. This has still been on an indisputable upswing, right? On an undeniable upswing in terms of sales, in terms of demand. Yes, we came down a little bit from the highs of 2020, but you guys can see still a strong number, still a really strong number. So happy with the demand side. Curious what happens to the demand side as rates continue to rise, and curious what happens to the demand side if they continue to run up against the inventory blockade. All right, median days on market. No surprise here, guys. 18 for December. I think we were actually 11 in July or August. Sort of ridiculous. I think actually we even hit a week, 7 days on market. That's a median. Half the listings sold in over a week. The other half of the listings sold in fewer than 7 days, less than a week. So pretty miraculous, pretty incredible. 116 days down to 18. Might as well scrub 100 days off of our market times. Why not, right? 116 down to almost 16. So you guys can see the big decline, of course, happened last year, 2020, as we saw the big COVID shuffle, the reshuffle. People looking for more space for working from home, learning from home, entertaining from home, exercising from home, having some outdoor play space at home, and everything else that went along with that. So homes are selling quickly, like hotcakes, guys. I don't need to tell you that, but I did anyway. There's the data. All right, December median price, shall we? For December, only up about 8% to 331. Last December, well, excuse me, 2 Decembers ago, I still have to get my head on with that. In 2020, December of 2020, we saw that 10% gain. That was the strongest we've seen since 2013. And yes, we had a gain, but we decelerated, right, from 10 to about 8%. Still positive, but at a lesser rate of gain, a lesser rate of increase. Don't believe me, right? You can see it slowing. Look at 16% price growth in May, kind of slowing down a bit into last year. Year-over-year change in price, right? In addition to looking at price, it is useful to look at year-over-year change in price to just sort of get a sense for the trend of what's happening with the change. So, really since the beginning of 2012, well, not quite the beginning, looks like maybe March, right? Should we get geeky? So 2012 looks like we got Jan, Feb, and then March. So starting in March of 2012, we haven't, since then, we have not seen a price decline, right? So what is that? Or is that 10 years? So yeah, it's about 10 years of price gains, right? 11? Yeah, quite a while. So, prices were accelerating a lot here. They were growing a lot, 18%. And then we sort of settled into, sure, we had some 10 percenters, but mostly 4 or 5, you can see 5, 6, 7%. And then look at the re-acceleration that we saw, kind of at the end of first quarter, around March, April of 2020. We saw a little bit of a pullback, in basically April and May. But by June, I mean, the competition was on. The multiple offers were on. Frustrated buyers were a thing. So yeah, we really saw this acceleration. We hit 16.6%, as you saw, not quite the 18% we saw as flippers and investors descended on the market in this first phase of recovery. And then we get into the more mature phases of recovery. And then we had COVID hit, right? And then we had a pandemic still. And so you can see price growth still positive, but slowing, still growing, but not at the same pace. Okay, that's important, guys, right? Prices softening, right? Prices are not falling, and I don't believe they will for some time, just given the supply-demand imbalance. That's not to say Wyzetta will follow that trend or that Loring Park condos will follow that trend, but I really think overall it's going to be hard to see that just given where we're at. December, the percentage of original list price received at the time of sale, right? At the closing table. So sellers accepted, yielded, realized, right? Got 99.5% of their original list price, 99.5%, down 0.2% from 2020, but the second highest December on record since 2003, right? You guys can see when we rode that wave down into the Great Recession. And then remember that tax credit? I think I actually noted that back here. Yeah, look at that tax credit period. A little bit of an increase there. Same thing, right? There was an incentive. There was a policy change in the market. Sure enough, we can see that. We can see the signature, right? The hallmark of that policy in our data. It's right here. So look at June. I want to go back to June, you guys. In June of last year, yeah, we hit 104.25. 104.2% of original list price. You guys can actually see we had 2 declines. Pardon my, I gotta shrink the font on this. When we add a year, we just added the year. Well, I guess this was June, so I added this a while ago. I have to fix this. Apologies. So it's a little hard to see, but 100.3 down to 100, down to 99.6. So we actually had 2 years of declines in this metric, right? So that was a softening. Right? That was a softening in that metric. And then we saw a 4.5% jump like we just haven't seen before. So unbelievable number. Inventory, nothing to worry about here. We've got plenty of it. That was a joke. Inventory, boys and girls. This has been the factor. It's been the metric, the indicator that's been impacting and driving the rest of the market, right? It's been driving prices, market times, the ratio of sold to list price, like we just saw, absorption rates, offers. It's investment activity, builder activity. It really ripples throughout every sector, every part of the industry, right? So last month, December 21, we were down 24% to not even 4,500 active listings. Under 4,500, right? We had 28,500 properties listed under active status in December of 2007. 28,000. Now, hold on, right? That was probably a little bit oversupplied, but remember, sales are as high as they've been. So, clearly we need to be higher than this. I don't know that we need to be quite at 30,000. But I do know, I think we need about 5 times. So 5 times for just about 23, 25,000. So I guess we do belong kind of around here. And that's to get our absorption rate to 5 months, right? Because we're at about 1 month of supply, right? So 5,000 actives is about 1 month of supply. So 25,000 actives would be about 5 months of supply. So technically, we do belong around here if we want a balanced market, but we have no such thing. No such thing. Seth has a comment, 28K with less area included. Not true. No, sir, not true. That is the 16 counties. So this is all for the 16 county metro area. If that's what you meant, I just wanted to clarify that. Let me know if I'm missing something there. We did sort of recast the net. We recast the net more broadly on that whole 16 county region. You are right, though. We went from the 7 county to the 13 to the 16. And I think we actually dropped a county based on the census numbers from 2020. Months of supply of inventory, right? 0.8 months, not even a month, you guys. We have 3 weeks of supply. 3 weeks of supply. It's absurd, right? It's absurd. It's there aren't really enough words for it. We are drastically, horrendously undersupplied, right? I can't really overstate that. Just another interesting note here, we blew past, right? We blew from balanced to undersupplied. We blew from 5 months down to about 3 as the market started to recover. We thought 1.5 months were low. Oh, maybe we're recovering a little bit. Oh, no, we're not. Oh, we're definitely not, right? So is this the year we see more new supply? Possibly. We had a lot of people refinance, and I think they're pretty keen on holding on to their interest rate, especially as rates rise. And I think it's become a self-fulfilling prophecy, right? I can't list my home unless I've got somewhere to go, and I don't have anywhere to go, so I can't list my home. Every seller gets locked in that sort of vicious cycle, and the gears kind of get rusted shut. Okay, I won't spend a ton of time on this, but just understand, I know some of you have seen this before. I want to go through it because I thought I saw some new names. I thought I saw some new names on the list today. So welcome, glad you're here. And I just want to touch on this. Absorption rates. What do we mean when we tell our sellers, we have a listing, we tell our sellers that it's a seller's market? What the heck does that mean, right? What are we actually saying? What we're saying is there are a lot of buyers competing for your home. Right? There are 1, 2, 3, 4, 5 units of demand that are all competing over 1 unit of supply. Low supply, high demand, right? Shorter market times. Sellers have pricing power, negotiation power. You'll see multiple offers, right? Much more common. How about a buyer's market? So here you've only got 2 units of demand, but you've got 3 units of supply. So these buyers are saying, well, if you won't accept 250 grand on your $300,000 listing, maybe this guy will. Right? Or this gal will. So effectively here, buyers have to compete with one another over this listing. Here, sellers have to compete with one another over these buyers, right? So this is where we see price concessions, price reductions, seller paid closing costs, and a lot of physical repairs on the property based on the inspection report. All we want is a balanced market. And it seems ever elusive, right? So, 5 to 6, some say 4 to 6, really 4 to 7 months of supply is relatively well balanced. And we're under 1 month, right? So we're just not there. Okay, looks like we had, what else do we have? Lenny, okay, sorry, I didn't have a question. Must have been by accident. Oh, okay. Let's see, Greg, with 3 weeks of supply, how are some brokers suggesting the market is moving toward being balanced? Yeah, I will comment on that. I think, well, first of all, there's data and then there's anecdotes, sort of what we hear on the street. And they probably are, you guys are probably hearing things on the street that I'm not, right? I'm not a practitioner. All I do is sit with the data. I hear from leaders, I hear from agents, I hear from our board, folks who are in all parts of the business and areas and price points. So I think I'm fairly tuned in, but I don't have my ear to the ground like I think an experienced broker would. I think what they might be referring to is, are we really running up against the inventory wall where buyer activity could be a little bit flatter, maybe a little bit less competition, more balance? Might interest rates put a cap on price growth? Because as rates rise, we can afford a little bit less of a monthly payment and therefore a little bit lower of a price. So might that put a cap on prices? Possibly. In days on market and everything else that follows, maybe there's some evidence things are starting to loosen up, but no, the data does not show an increase in inventory. The data does not show a decrease in demand. So we're not there yet, but I don't disagree that we could be moving that way. what I will say, I guess I'll climb out on the skinny branches here. What I will say is I truly believe this year will be less competitive than the previous two. I think it'll be a little bit less competitive, a little bit slower. Sales still might rise 2 or 3 or 4%. They might fall 1 or 2 or 3%. But I expect prices to continue to rise. Maybe days on market tick up a bit. Maybe the percent of list price received ticks down a bit. So I don't totally disagree, but we're not seeing it in the data yet. Okay, questions rolling in. Seth, will baby boomers retiring and downsizing help with supply? So here's the thing about that. We don't have any townhomes for them to downsize into, right? We don't have single level townhomes with bedroom, kitchen, laundry, all on the main, right? We haven't built it. We don't have the lots. We don't have the labor. Lumber was so expensive, right? I refer to the 5 L's: lots, labor, lending, lumber, and laws, right? One of my favorite little mantras, 5 L's, right? So we haven't built product for them to step down into, to downsize into. And, not all want to go to managed care, right? Not all want to go to, a senior care facility. So there's this huge trend of aging in place. There's a ton of literature on it. Our baby boomers, our seniors are aging in place. They're staying where they are. They're doing, they like their library. They like their little, Hy-Vee or Cub or Fresh Time or Whole Foods or whatever, right? They like their, they like their church or synagogue or mosque, right? They like where they live, right? They like their home. By the way, it's paid for. So all you really have is taxes and insurance, which is pretty affordable. So, maybe a little bit, but not as much as it would have, say, 20 years ago. Another thing I'll say, and I'm quoting someone on this, I asked, what other factors besides the obvious ones do you think are sort of stopping up the market or putting a wrench in the spokes? And one gentleman looked at me and he goes, widows. I said, well, what do you mean? Typically, we don't like calling out, specific groups in this industry, especially, protected classes. I'm not sure if widows are, but he said, no, he just meant how many single, or I guess the term is surviving spouses, right, stay in that 4 or 5 bedroom home, right? They stay there. And that 5 bedroom home really is built for a family, right? It's built for, these millennials with growing families or, any other generation. It's not really designed for a 1-person household, but they own it. It's a free country, relatively free. And so, I guess they can do as they please. But we have failed them. We've also failed ourselves as a region and them as a community by just not building product for them to step down into. The other thing I heard that's interesting is golf courses. Someone was talking about Bear Path in Eden Prairie. Bear Path, yeah. And they were saying, some of these homes, $600,000, $700,000, $800,000 homes, millennials aren't playing golf. I don't know, this gentleman was saying he doesn't think that this next generation of home buyers that are coming into peak home buying and home ownership age, he doesn't think that they value living on a golf course. So will they pay that premium to be there? I love the idea of open green space and not staring across at a commercial building or at another, at a bunch of other houses. So I love that idea. But are today's home buyers willing to pay that same premium that folks did 10, 20, 30 years ago, right? Interesting thought. All right, let's keep going, guys. We got to keep trucking. Time check, 37. We got a lot of stuff to do. Okay. So, this one's pretty wonky. Let's just suffice it to say, all these markets are undersupplied markets with rising prices, right? This side of the line, rising prices, this side, falling prices. North of this bar is low month supply. South of this bar is higher months of supply. So what's happening here? These are undersupplied markets, 2 months, 4 months of supply. And they're on this side, so they're rising in prices, right? So undersupplied markets with rising prices. And then we have oversupplied markets, right? 6, 8, 10, 12 months of supply. Which side of the line, which side of zero are they on for price? They're on the negative side for price. So these are oversupplied markets with falling prices, right? There's a trend here. There's an undeniable trend here. There has not been a single time since 1999, not a single month, where as a nation, we've had under 6 months of supply and prices have fallen. Let me say that again, not a single month since 1999 have we had fewer than 6 months of supply and prices falling, right? What does that mean? Prices rarely fall when we have less than 6 months of supply, and we are a long way from 6 months of supply. I find that pretty compelling. How about you? All right, year-to-date new listings. Let's look at some annual numbers, you guys. So preliminary, but they're not going to change much. I promise they really won't change much. We could go from -1.1 to -1.2 or -1.0, but these are pretty set in stone. Although watch Monday for our annual report to be released. New listings, riding the wave down, up a little, and then flat for a long time, right? This is the definition of just sideways movement. We're just kind of bumbling and fumbling, right, kind of between 75, 75 and 78. I guess maybe 75 and 80, call it. We need more. We need more seller activity. Down 1%. That's what we're looking like. Down about 1%. Closings, record high, all-time high. We can only say that with certainty going back to 03, but there's no way sales were up here prior to 03. There's just no way. So I am 99.999% confident in saying that this is an all-time high, right? All-time high. So up just under 3% to about 66,300. And you guys can kind of see how things looked every year, in the prior 18 years or so. Tax credit. Remember when interest rates rose in 2018 a little bit? Looks like that could have affected sales a little bit. 2020 up 8%, and then tacked on another, 2.5-3% last year. Price year to date last year we're looking like 11.5% to just about 340. So 340,000, and that's up about 11.5% after 9% in 2020. 11.4. Let's see. Sure enough, I got to go back to 2013, right, to find price growth that strong. Right, so that's a multi-year high. Really a high watermark. Really a strong turnout there. All right, let's keep trucking. So for an annual figure, the percent of original list price, we didn't quite break 102. So even though June was what, 104.2, and December was 99.8, was it? So overall for the year, about 102. And you can see, even though down in 19, right, really strengthened into 2020, at least in the second half of the year. And then obviously for most of 2021, if not all. Okay, now we're getting into the interesting stuff. Oops, forget that one, guys. Let's look at this one. Okay, so August. Percentage of sales with a price reduction. A little bit of a price reduction analysis here for your Thursday. Saw a little bit of an uptick, right? 18 into 19, a little bit of an uptick, 13 into 14. Saw no such thing from 2020 into 21, right? Down into 20, down into 21. Price reductions, not as prevalent as they've been, right? No need for them with all this demand. There's just no need. October, instead of looking at August, let's fast forward to October. In October, I did register a little bit of an increase in price reductions, right? So price reductions a little bit more common in October of last year than in October of 20. Let's see if we can follow this along. November, right? So here's October, here's November. I saw that same uptick from 24 to 26%. So, okay, that could be a coincidence. And then I think I did check December, and we did have a little bit of an uptick there. So 3 consecutive months of a trend. is that a pattern? It's starting to feel patternistic. I don't know if it's a trend that's going to stick around for this entire year, but it's something that I promise we'll keep monitoring this. This is one that it's a great indicator, along with others, especially days on market, month supply, and the ratio can really give us an early insight into any market shifts, right? Again, I don't know that I'm calling this a market shift, but agents and sellers have had to reduce prices, a little bit more in 21 than they did in 2020. Look at this, guys, compared to every November since 2003, this is an absurdly low number. It's an absurdly low number. However, it is a slight uptick. Okay, we had one more question. Let's see. On this, does sale refer to pendings? Percentage of, great question, closings. Great question. So these are officially closed units.
And David, just while you're answering questions, it looks like Greg put a question in the Q&A area regarding supply and projecting when a balanced market may increase. Just wanted to give you a heads up on that if you had a chance to look at it.
We did. I think we did address that one, but I think we're going to keep kind of talking about it as we go forward. Thank you. Thank you. I appreciate that. Okay, let's see, guys. Let's keep sticking on this topic, percentage of sales with a reduction. Let's just check out November. So I've teased out November and I've sort of highlighted it in orange for us here. And I think you guys are going to get a kick out of this, just kind of looking at it. So look at the normal, right? Look at the normal shape. How does this normally look? Looks like a U, right? It looks like a U. In 2019, it looked like a U. In 2021, it looked like a U. In 2020, it looked like a W, right? U, U, double U, right? So look at this, November. Well, you know what? Let's actually take September. So look at September. September, let's take 9/2019 here. We had 1, 2, 3, 4 increases in the prevalence of price reductions heading into September. 2021, let's do the same exercise. For September, we had 1, 2, 3, also 4 months of increases in price reductions heading into September. How about September of 2020? Here's our 9, 20.8. We actually had 1, 2, 3 decreases into September, right? Clearly something was different, right? And we know what that was. Clearly something was very, very different. It speaks to activity being pushed into later half of the year, where the market was so hot in September that sellers didn't have to reduce prices or make concessions, or do seller pays as much, right? Not as often and maybe not as many dollars, right? So I think that's just fascinating data to look at. Then again, I would think that. All right, what else we got? Time check 47. Okay, we're a little low on time, so let's kind of blaze through this. Zillow exiting the market. Some of you have heard about this. Here's something on Bush Lake Road. Zillow has it. Looks like they're on at 475. Okay, so August, so 475 to 469 to 459, 449, 24, 19, 14. Fine, we'll go to 399.9. So I don't know if it means they're desperate to unload, or if they were really priced high, or if they're heading into earnings season and, I don't know, whatever. But that's a thing. Cash deals as a percentage of sales, 12.5% last year. That's not out of line with the last 5-6 years. It's obviously down from when we saw all that investor activity in 2010, 11, 12, and even 13. Prices started to rise. Investors felt there was less return, right? Less opportunity there. Interestingly, though, 4.5%. So even after we sort of settled into, after this whole crash, and we've sort of settled, well, I don't know if I can call the last few years settled. This pattern has sort of stabilized. Maybe I should say that this metric has somewhat stabilized, but it's 2 to 3 times as high as what it was sort of pre-Great Recession. And I think that's people that are still chasing yields and returns in, REITs, investment. People are keeping their first home and buying their second and then renting out the first. So I think people are seeing residential real estate as a really safe asset class that's been appreciating and is likely to continue appreciating. And I don't know that we quite saw it that way, maybe not to the same extent. So we see more cash in the market, and it's been hanging around. Investors, some of you have been reading about this. Investors are not bad people. And, yes, investors bought a record 90,000 homes in the third quarter. Some have an idea that, when an investor buys a property, by definition, that takes it away from, a consumer, a regular person, Sally, Joe, Mary, or John, who would buy it. That assumes that that person would have been a buyer of that, and that wouldn't be a rental, anyway. So, while this trend, does look alarming, in our metro, I think the Federal Reserve has great data on this. They just launched a data tool, actually Tuesday. And it's only gone from like 2% to 4% or 2.5% to 4.1% in our metro. It's a pretty small share. However, there are parts of North Side and Northeast that are 35% investor owned. No matter what you think of this trend, and whether you think it's a political, politicized thing, big bad investor corporate versus, the little guy, it kind of is what it is. I think this is probably going to be, for better or for worse, I believe this is going to be one of the next major regulatory fronts. Vancouver has already done something. They did something years ago. I think the rule is, I don't know if it's a block or a zip code or a census tract. They have some rule where like a neighborhood can't be more than, like 20% or 30%. It's either investor or foreign owned. There's a ton of, mostly Far East Asian investors, Japan, China, South Korea, who were really making significant investments in that Vancouver condo market, and they just drove prices so much higher. But it's not like you had, you did have population growth, but those people weren't living in them. Some of them were sitting empty, and then people can't buy them because they're sitting empty. So I think politicians are going to look at this and try to do something about it, whether that's necessary or not. That, I'm not sure we're convinced of, but just know that that is a thing that's happening. Okay, let's keep trucking. Inflation, you guys have been hearing about this. You've been reading about it. Inflation has hit multi-decade highs. However, it's been running well below average for over a decade, right? So we've been 1.5, 2% inflation, and now we are 6%, 7% inflation for the time being, right? So when you average it out over, several years, it's really not as bad as I think some of the media would have us believe. But yes, the consumer price index is rising. Yes, it has to do with supply chain constraints. Yes, it has to do with people shopping online. Yes, it has to do with all of that. So let's take a look. Home prices, nominal home prices in red. This is just the number, the number that we paid, right? 350 grand. What about implied home prices or real prices, inflation adjusted prices? Well, this is where we'd be at, right? If we were paying in just $2,003 with no inflation, right? Here, we're paying in $2021, which are inflated compared to 03. If we're just paying in $2,003, look at where home prices are. Sure, they're above bubble levels, they're at new highs, but not by that much, right? And that sort of suggests that we have some runway ahead of us. There's some room to run. When you look at, sort of nominal prices or just the number, right, that you paid, yeah, look at this stretch, right, for 2021. You can really see prices rising even faster, than they had been. So look at how much higher we are above our peak here versus how much higher we are above our peak in blue, right? That difference is attributable to inflation. Just for fun, right? Because we want to be thorough and make sure we're covering all of our bases. Let's do just the opposite. Now let's frame this in 2021 dollars, constant 2021 dollars. So here, nominal home prices in red again, but then we have inflation adjusted prices in blue. So if we paid in 2021 dollars, right? No, prices wouldn't be at 230. If we paid in current dollars, prices would have been at 325 back in 05, 06, right? Because we'd be paying in today's more inflated dollars. So whichever makes more sense to you. Some people, I guess I think this way makes a little bit more sense because as the years go on, you can really see that difference kind of grow. Oops. And I guess you can here too, but I don't know. I guess I'm a fan of this one. You can just kind of tell the growth of inflated dollars versus a real inflation adjusted dollar. So fascinating stuff. Okay, million plus. Let's keep trucking, guys. Luxury. I know some of you are in this luxury segment. August, 51% increase in million plus deals. 51%. October, down 12%. Right after 100% increase in October of 2020, right, from about 70 to 140, just about doubling. So down. So let's check if that trend is going to continue. November, no. Now we're back to up, right? Now we're back to up 21%. December, still up 21%. So no, I did not confirm this October decline. This seems like an anomaly, right? That luxury could be slowing down, because November still saw significant increases. December still saw significant increases. I don't know what January will bring. The million plus market has absolutely shocked me last year. It has come into, you know what? It's come into balance. I just have to show you guys. It has been absolutely unbelievable to see. Let me just do my ranges real quick. 500 up to 999 and then million plus. Okay. Let's break these out. And just while I'm doing this, I saw one more. Eventually went into multiples. How does the Fed define an investor? That's a good question. I think that is, they do say
David,
it
I
on
have
their
that.
tool.
David,
Yeah.
I was trying to get a written answer written out, but you caught it before I was able to say it. So I will just interrupt you while you're searching. The Fed defines investor-owned property as a property that is, one, not homesteaded, and two, that same entity, whether it be a person, an LLC, a nonprofit, a bank, whatever, that same entity owns two or more properties in the area. And if you toggle that drop-down menu, instead of 2, you could say 10. Instead of 10, you could say 50. But the important part of what, Tony, you're asking about here, it has to be a non-homesteaded property.
Yeah. Thank you, Jackson. Yeah. Eric and Jackson have been, I mean, all of us, myself included, have been kind of geeking out on this because there's just been so much attention and, in the media, in the industry, around City Hall and at the Capitol and whatnot. So, yeah. So, as was stated, there does seem to be a little bit of a geographic trend here in, where you might find some of the more affordable opportunities that does tend to correlate to higher levels of investor ownership. Here we go. Here's the share. Let's see if I'm right. Total. No, that's not right. Oh, that's because 10. How about 2 or more? Okay, there we go. So 4.1. Let's see if I was lying. Yeah, about 2% to about 4%. Okay, so I was right. So in 15 years, we've gone from 2% to about 4%. We don't think of that as alarming, in any respect, but it is worth watching and paying attention to. So I'm glad we touched on that. Million plus. Okay, so December, yeah, guys, we have not broken trend, right? So year to date, yeah, up 50%. They've tripled. Million plus deals have tripled, right? 500 to about 1,500 compared to 05. And you know what? I forgot, guys. While this was loading, I just wanted to show you. All right, so I'm going to be moving kind of fast. Please bear with me. Let's do month supply. Let's increase this. And you know what? Well, yeah, so look at million plus in purple, right? Million plus used to have 33 months of supply, 33. Then it got better, 15, 16 months of supply. Woo, we're getting better, right? Half. Hey, all right, there's been some movement here, 11, 10 months of supply. Oh my God, million plus has 4.1 months of supply. 4.1 months of supply in million plus. I can't believe I'm saying this, but the million plus market is a seller's market. Let me say that again. The million plus luxury market is a seller's market where sellers have power. Sellers have negotiating power. I would therefore expect days on market to be down 66%, right? Look at market times, 75 days for million plus, down to 3 weeks, 2.5 months down to 3 weeks, right? That is It's seismic. It may seem wonky or granular, but that segment, that luxury segment, guys, the folks with the financial wherewithal to make a move to improve their living situation without even selling their previous existing home, they can. That's what they did, right? Power to them. This unbelievable. So let's see. Sellers ought to be getting much more of their asking price in million plus? Sure enough, right? 3%, the biggest gain of any segment, up 3%. They're getting 98.5% of original. I'm still crunching the numbers here. Let's just make that go a little faster by just clicking on that guy. Okay, look at that, guys. Pandemic. Let's see. Yep. So there's March and April, pulled back just a hair before we realized, oh my God, let's make a move. Let's buy up. Let's move up. Let's do luxury. Terrific. Most of this is single family, but some of you are aware of the condo project 11 that's opening, and there are, dozens and dozens and dozens of million plus units there that have sold. And I hear almost no one is backing out of those contracts. So really a strong market and continues to be strong. Another strong market, a market that has seen its market share return are the two core cities, our beautiful core cities of Minneapolis and St. Paul, right? So lately, we've had the highest share of activity in Minneapolis and St. Paul in the two core cities in 6 years, right? So we hit a 6-year high. We really do think that's important. I want to just do a few more. I know we're just about at time, so let me skip a couple here. And I really want to do this one just in case someone hasn't seen this one. So we talked about all three of these. Median sales price, dark blue, right? Here's 05, heading into the bubble, then the downturn, and then the recovery that we've been in. So that's home prices, all-time high. Mortgage interest rates. This is an index, you guys. So they all start at 1, and then it sort of measures the change. Interest rates, right? Just about at all-time lows from 1990, even compared to 1970, right? The lowest levels. Prices as high as they've been, rates as low as they've been. So that dynamic has offset PITI payments, right? Principal, interest, taxes, and insurance. The monthly homeowner costs have actually been kind of flat. Interest rates have been, the absolute blessing from above that have offset that impact of rising prices. So I think that is just such a great way to kind of see that and think about it. One or two others, you guys, I just want to show you average equity, over the last 12 months, Minnesotans have gained on average 33 grand in equity. So we're sitting pretty on equity. Even if prices were to decline 5 or 10%, which is really hard to envision, we're still not going to have a wave of foreclosures, right? It's about 0%, even with forbearances, right? Because those loans are not delinquent anymore. A very small share of them are. They're coming out with loan mods, or they're coming out of forbearance. We've seen a lot of recovery there. So that's a good thing. And then I just want to show this one because so this was sort of the rate forecast, averaging all four: NAR, the mortgage bankers, and then Fannie and Freddie. And you can see, right, first quarter this year, about 3 1/3. They're about 0.2 shy of where we are. And then by the second quarter this year, so, by about April, they're thinking 3.5. Well, we're already kind of at 3.5. And then you guys can see what they were thinking from there. Okay, 2 more, I promise. Not even in slide mode. God, look at me. All right, estimated price growth. Man, oh man, did they nail that? We're 11.4, right? And this is national. So we're 11.4, just about what we're thinking for the nation. As we move forward into the next 4 or 5 years, expect to not see this kind of number, right? Expect to not see 10, 11, 12, even 16%, right? Expect more like 5 to 7, 4 to 6%, right? 3 to 5, 4 to 6. By the way, 4% minus 2% to inflation, which is typical, equals 2% real appreciation per year. That's what this industry has been saying for a century, right? Over a century. Okay, last one. Home price forecast, right? Based on the experts. So, NAR a little more bearish. I thought that was interesting. And then Fannie and Freddie. So they're thinking just about 5%. I think that's a pretty good number. And with that, sports fans, I'm going to stop in the name of love and check if we have any other questions.
It does
Nothing?
not look like we have any other questions, but we can wait just a moment or two if people are typing them out.
Yeah, let's give it a second. And just while people are thinking, I do want to show one other thing here. This is going to be a surprise to most of you, right? Let me break out our property types and let me look at just sales. I just want to see demand. What is this? Okay, I just want to see demand here. And for this one, I don't usually do this, but let's look at bar charts. Sometimes they are handy. Guys, I'm on my rolling 12 month. Rolling 12 months in December is the whole year. So we're looking at the whole year. Single family sales up 0.8%. Townhome sales, okay, 2.7, 2.73%. Condo sales up 25%. I think people are going to be surprised by that, right? I just don't think that people expect that. And that's what happened, right? That's the fact. So I think the media will pick up on that a little bit because that may be a surprise.
Great time to buy a condo, right, David?
I know some people who have lately.
We do have a question from Josh. Is this slide deck available to download?
Absolutely happy to send it to you guys. Shoot me an email. More than delighted to share.
And would you be able to go back to your slides so that way they can catch your email one last time?
Yes.
Perfect. Well, thank you, David. And thank you, everybody else, for joining us. This concludes the end of the January's monthly housing market update. And we'll see you all in February.
Thank you all. Thanks, Jackson.
Bye, guys.